Investing in retirement requires a greater margin of safety as you're selling assets, and drawdowns can have a painful impact on your finances. In this video, I'm going to look at some alternative funds to a global equity tracker that you could consider investing in once retired. So if we look at something that has a mixture of equities and bonds in it, we could look within the category 60 to 80% equity allocation. And using the website Pickafund, we can find there's an absolute banger of a fund, which is Orbis Global Balanced. And it's ranked number one out of over 300 funds in that category across 10, 5, 3, and 1 year. So that's an absolutely amazing achievement, and it's compounded at a double-digit rate. So here's the performance of the fixed fee version compared to a global tracker, where the fixed fee Orbis is the blue line, the global tracker, which has suffered from things like the Trump tariffs debacle, is the orange line. And then for a longer term history, here we've got a comparison where we go up to 10 years for net returns. That NTR is net total returns. Orbis underperforms a global tracker on a 10-year basis, but over the other time frames from 5 years onwards, it outperforms. And then quite importantly, it's got a lower 3-year maximum drawdown than a global tracker. So Orbis is at 8.21% as the maximum loss you could ever have seen on your investment in the last 5 years, compared to 9.29% for a global tracker. And that compared to outperformance of Orbis over the 3-year period gives the Orbis fund a higher Sharpe ratio of 1.47 compared to 1.07 for the global tracker. So the Sharpe ratio is the return of the asset you're looking at less the risk-free rate of return, which used to be close to zero. Now it's maybe as high as at 4%, less the volatility, also known as a standard deviation of the return of the asset that you're looking at, because the volatility of a risk-free asset should be zero, so there's no need to subtract that. And so this is looking at excess returns from your investment per unit of risk, and the higher the number, the better. So what does Orbis Global Balanced actually do? Well, it calls itself a contrarian value fund. So value is just looking for things that are cheap in terms of maybe things like the price to earnings ratio, so how much they sell for versus the profits that they generate. Some things are kind of always cheap, like regulated utilities, but contrarian value is things that are now kind of unpopular, they've fallen out of favor, and that means that some people think they're attractively priced if they come back into favor. So a classic example might be defense companies, where you had this rise in ESG investing, so no one wanted any defense companies, and then suddenly Trump is telling NATO, well, you've got to spend more on your defenses, and you've got things like Ukraine war and conflict in Gaza. So you suddenly got this huge increase in defense spending, and that's being filled by companies that were on incredibly low PE ratios because they were unloved at the time, and that meant that these defense companies could grow quite strongly over a long period of time. So here's the asset allocation of Orbis Global Balanced. It's 77% equities, although after taking into account some hedging and some maybe voodoo type stuff, that comes down to 61% net equity, and then fixed income, which is mainly government bonds, is at 18%, and then we've got commodities, things like gold, coming in at 4%. And then within the equities, the Orbis Global Balance Fund is using this kind of macro positioning to take on a series of hopefully low correlated exposures, and it's got the list there where it's saying that 53% of the fund was involved in about 7 or so key themes. So it's things like infrastructure, inflation-linked government bonds, metals and mining companies, gold, technology that is not in the US, it's more in Asia Pacific, excluding Japan, and then aerospace and defense. So if these themes play out well, then the fund will do okay. And then if they don't, then the fund might start to falter. So this fund is not without risk. And we can kind of see that where in 2018, 2019, the fund wasn't that well positioned and it didn't really perform that amazingly. But really since the COVID crash, the fund has really taken off. And then here we've got the top 10 holdings of the fund. So physical gold, number 1. The tips are Treasury, inflation protected securities, those inflation linked government bonds. We've got some of the IT in Asia, ex-Japan that we was talking about, some of the mining companies as well, and government bonds outside of the major currencies. And then what's really important is the characteristics of the portfolio. So at the top, we've got how quickly the portfolio is kind of churned and turned over. So for the name turnover, it's saying that company, it will hold it for an average of 3 years, so 33% turnover per year. And then in terms of the value that's turned over every year, that's going to be about 53%. And then next up, we've got what's called the active share, which is how it differs from a global tracker, from the index that it's looking at. And here the active share on equities is incredibly high at 97%. So this would sit well alongside a global tracker because it's got completely different weightings in the holdings from a global tracker. So you won't get the overlap, and potentially you'll get low correlations between the returns on the Orbis Global Balanced and a global tracker. So for Orbis Global Balanced, there's a standard version that has no ongoing charges fee, but it has a performance fee. And because the fund has outperformed so magnificently in the last 12 months, this 40% outperformance fee is driving 8% in total fees, which is completely insane. So you want to avoid the performance fee version, even though they say, oh yeah, but we'll claw it back if we underperform. But if it's been number 1 for 10 years, I mean, it never underperforms. So you don't benefit from any clawback at all. So you want to go for the fixed fee version that comes in at 1.2% per year, which isn't cheap. So again, you need to bear that in mind when you're doing your analysis on this fund. So Orbis itself is a private company, and some people feel that if you've got a fund manager that's privately owned, you're much more likely to have the partners and the owners of that firm actually investing in the funds that they have. Whereas if it's just a quoted company, then it's all about driving the share price, getting share options and bonuses, and the actual fund managers, people that work for the company, aren't the owners anymore. They sort of passed it on to someone else. So that's a possible plus for Orbis. And then also Sean Pesh of Ranmore used to work at Orbis. So if you're a fan of Ranmore, then Orbis is maybe one to hold alongside it. For all your retirement planning needs, check out my school community. I'll put a link in the description. So we wouldn't want something like Scottish Mortgage, where we've got the maximum drawdown the last 3 years, 18%, and the 3-year returns are lower than Orbis anyway. So although Scottish Mortgage can have its time in the sun and it's got the 10-year returns at 17%, the 5-year returns are only 2%, and it's still off its long-term highs. So we've got a much lower ratio, on a Sharpe ratio with the Scottish Mortgage. So it's more something to invest in if you're young and you've got the time for it to play out, or maybe if you're really keen on these sort of satellite type of plays. So if we use Pickafund to select what we're interested in, we can just hit select categories, and then we can search on 3-year Sharpe ratio. And then we can also do funds with a platform. And now we've got a 3-year Sharpe ratio, 4.91 for this Gamstar bond fund. Sometimes, overnight money market funds can have very large Sharpe ratios. Man Dynamic Income, Sharpe ratio 2.68. And we can just keep on going down, looking at different equity and bond funds to find, here's Jupiter Merian, the best funds that we're interested in looking at. So there are quite a lot of cautious funds out there. So one example is a minimum volatility global ETF, which is on the left here, and we've got the maximum drawdown over 3 years of 5.57%. So, that looks pretty good. But the problem is, to get that low drawdown, you also have low returns as well. So in a way, you're probably just worse off with this minimum volatility fund, and that's kind of reflected in the Sharpe ratio. So there's quite a lot of certainly passive funds that claim to be diversified and are much more smooth in their returns, but actually the growth is just too pedestrian, and you probably die of boredom waiting for it to grow and give you a decent return. So here's another favorite of mine that is worth looking at. It's a corporate bond fund, Man Dynamic Income. I think perhaps the returns in its early years, so these 3-year returns, probably not repeatable. It was a lot smaller, a lot more nimble in the early years, but the 1-year return of about 11%, I think that is possible. We could see that in the future. It's got a very low 3-year maximum drawdown of only 1.7%, which is pretty phenomenal. It's got a huge Sharpe ratio. So this is one to consider if you want to diversify and get pretty solid returns that are reliable. And the graph here backs up the numbers in that table. So also on the bonds theme, we've got this cat bond fund. And what the hell are cat bonds? Well, it turns out they're catastrophe bonds, and it almost seems like the Scottish play where you can't mention the name, so you call it cat instead. So these are bonds where you invest in the occurrence or non-occurrence of like earthquakes and tsunamis and even cyber hacking as well. And you get quite decent returns if these events don't occur. But if the events do occur, then it's a bit of a different story. So we've got a maximum drawdown of 4% because this fund would diversify across a whole range of risks that wouldn't occur at the same time. But the problem is that if a tsunami comes along, then your funds are literally wiped out. So there are some interesting absolute return funds. This one from Jupiter Merian is long short equity, and that's to be believed. I mean, less than 1% maximum drawdown is just amazing, and it's compounding at more than 10% a year. So providing the quant model stays intact, then this is a good thing to look at further. I've done a video on long short equity, and I'll put a link in the description. And here is the chart of the Jupiter Merian fund, so you can look at it yourself to see how well it's done. So one thing I do believe in is the impact of artificial intelligence on active funds, and I think it gives much more tools at the fund manager's disposal to screen for things like financial ratios, but then also the mentioning of words in a company's outlook. So things like massively exceeding expectations. You can search out for those words, and then you can look at the price data of the fund as well. And as there's more of this quantum computing power at a fund manager's disposal, it'll hopefully be easier for them to pick companies that outperform, that then drives decent fund performance. So we might see in the next 10 years more of a swing towards some amazing active funds coming to the forefront. Now, for some of these funds, they are open-ended investment companies, and that means that they're not going to be on platforms like Trading 212. But what we could see is a rise of active exchange-traded funds. So you've got something that is on a stock market, it does trade live, it is trading at a net asset value, and all those combinations could lead to some quite interesting funds emerging in the next few years. Hope you like this video. Check out this next one.